Hey there, traders. This is Steve Miley, the market chartist for FX Explain, and our regular weekly macro watch update for the week commencing the 20th of June 2022. Central bank activity leaves stocks vulnerable, but mixed signals elsewhere. Let's kick off by looking at those macroeconomic and geopolitical developments we've seen over the past week. Well, the past week has been dominated by central bank activity, like we haven't seen for some time in here. We had an emergency ad hoc meeting by the ECB, the European Central Bank, on Wednesday. That was to deal with the surging bond yields from the European periphery government bonds that the market has seen since the prior week's ECB meeting, when we saw the pivot to a more hawkish tone and the removal, or the beginning of the removal of the quantitative easing, and that's led to European government bonds selling off aggressively to higher yields, particularly the periphery. So the ECB stepping in with this emergency meeting on Wednesday. And then we had the scheduled Fed meeting on Wednesday as well, a 0.75% rate hike coming from the Fed, as the market had quickly priced in from only a 0.5% rate hike, which was expected only the week before. But after the previous Fridays, not last Friday, the previous Fridays, very high US CPI data showed inflation still running hot. Markets quickly priced in a 0.75%, 75 basis point hike, and the Fed delivered that on Wednesday and also hinted at potentially being even more aggressive going forward. And then the Swiss National Bank, usually not on our radar, seeing as they haven't moved or haven't hiked interest rates for 15 years. They hiked interest rates for the first time, admittedly from a negative to still negative, from a 0.75% negative 0.75%, hiking by 0.5% to negative 0.25%. But say the first interest rate hike for 15 years, unexpected, and did hint that further tightening may be needed. And then on Thursday, as anticipated, the Bank of England also hiked rates for the fifth successive meeting by 0.25%, and also indicated further hikes were in the pipeline. But then on Friday, the Bank of Japan stayed very, very dovish, despite central banks the world over shifting to a more hawkish tone. The Bank of Japan stayed very, very dovish on Friday, which saw the yen lose ground to the dollar yen spiking back higher. Now let's take a look at those global financial market developments for last week ending the 17th of June. Well, equity markets hasn't taken this more hawkish tone from the Fed very well. Equity markets gapping down early last week. The futures market in here gapping lower, and cash markets also gapping lower on the back of the higher CPI from the prior week. And then despite the Fed hiking rates and getting maybe back in front of the curve, an initial rebound Wednesday, but markets sold off Thursday aggressively. And the S&P now posted its worst day since March 2020, when the pandemic really started. The pandemic set off really broke. So its worst week, last week, and also entered bear markets territory, undercutting the low that we saw from May, closing the week out around just under 24% down, so entered bear market territory. Europe remains vulnerable too. We had a sell-off the prior week and then lower again. Here we look at the DAX and the recovery theme. The kind of outperformance we've seen from Europe in here more recently, certainly starting to decline, and we're starting to see Europe play catch up on the downside. Yields in there now, this is where I'm talking about mixed signals. So even though stocks remain vulnerable in a risk-off mode, if we look at what happened with yields, yield initially spiked higher last week. So the US 10-year yield spiking through up to like 3.5%. But then after the Fed, yields moving back lower. So potentially a blowout top in here. So really signaling in here potential for lower yield activity. So a mixed signal coming from the US 10-year yields. And similarly for the dollar as well. The dollar spiking higher at the early part of the week and then recoiling back lower in here, the dollar index. Again, a mixed signal compared to the more risk-off signals that we're getting from the equity markets. Gold in here also initially lower, but then did rebound and still trying to form a basing pattern in here on the gold future. And oil selling off aggressively last week, signaling at least a short-term top and maybe a bigger top developing for oil. But the copper market was significantly negative, breaking down through the low posted earlier this year and looking certainly more bearish with a very negative impulsive candlestick for last week. Now let's take a look at the week ahead, the week commencing the 20th of June. Well, we're still closely monitoring any developments from the war in Ukraine. Should point out that Monday the 20th of June is the US Juneteenth holiday. Cash markets are closed and partial days for the futures markets. And on the central bank side, we get the PBOC, the People's Bank of China interest rate decision on Monday. We get the Reserve Bank of Australia meeting minutes released Tuesday. Wednesday brings the Bank of Japan meeting minutes release. And then Fed Chairman Powell testifies to Congress on both Wednesday and Thursday. On the data side, it's like US cash markets are closed on Monday and partial day on the futures markets at PBOC interest rate decision. RBA meeting minutes as said on Tuesday. Canadian retail sales also Tuesday. Those BOJ, Bank of Japan meeting minutes on Wednesday. Then we get the first of the most significant data. UK inflation data and Canadian CPI data also on Wednesday. And Fed Chair Powell testifies to Congress. He testifies again on Thursday, and the standout data for the week is released throughout Thursday. That's the global S&P flash PMI data. And then we end off the week with UK retail sales on Friday and the German IFO survey. I'm going to wish you all a great trading week. Stay safe out there, and I'll be back with you with another macro watch next week. So traders, don't forget to catch us on the next FX Explained Macro Watch and all the great content on fxexplained.co.uk.